G'day guys, Phil here. Well, let me ask you a quick question. Would you rather have your mortgage paid off in 3.5 years and save yourself $50,000, $60,000 in interest? Or would you rather spend your money on bought coffees, bought lunches, takeaway, and those sorts of things? Now, this is the kind of discussion that I've had with 2 clients just this morning, and I wanted to share it with you because often we don't realize that those are the decisions that we are making. Often we don't realize that by allowing ourselves to make a non-decision, by allowing us to head along on automatic pilot, if you like, in terms of our spending, we don't realize what we're robbing ourselves of. Now, the guys that I had a conversation with this morning, in fact, let me share with you, this is one of my clients' budgets. Now, I've been working with this couple for, believe it or not, 13 years. We realized that we'd been working together since 2011, and they achieved amazing things through the first part of us working together. They paid off huge amounts of personal debt, credit cards debt, car loans, those sort of things, took control of their finances, and nearly paid off their home loan before they started having a family. In fact, they got it right down from about $350,000 down to about $100,000 at the point where they started a family. Then they made the choice for mum to stay at home with the kids and for dad to obviously continue working, but to be a single income family. And so they budgeted really, really carefully for those months or for those years rather. And then what happened is, as they started to come out of those, what I call the really difficult financial years, where it is pretty hard going, where either you're at home with the kids or you're paying childcare, one of the two. But they came out of that, and then their income started to increase. Mum took on a part-time job during school hours, and dad's wages continued to grow. And so now they're in a position where for the first time in quite a few years, they actually have some spare cash flow. Now, as a result of that, what we've seen over the last few months is that their spending has also started to increase. In fact, this is probably over the last year or so. Their spending has started to increase. Now, if we have a look at their situation here now, they have their average monthly expenses are $7,785. Their average monthly income now is $10,535. So potentially, that means that each month they should have a surplus of $2,749 if they stick to the budget. Now, here's the big if, because if we look at what's happened with their spending over the last few months, particularly with their everyday spending. Now, the everyday spending is things like the groceries, the petrol, the parking, the entertainment, the bought coffees, the takeaway, and so on, bought lunches. If we have a look here, now I'll start back in July. We can see in July that each month they're allowing $2,278 for their everyday spending. But they spent $3,500. If we have a look at August, similar thing. They allowed $2,278. They spent $2,826. And if we have a look at September, so the most recent completed month, you can see they allowed $2,278 and they spent $3,413. So their spending has got a little bit out of control, and I've said this to them many times, is that the average amount for a family in their situation for their everyday spending is around that $2,200. They're not far off the mark of being in that average zone where what they're spending is what they're allowing is about right. Now, of course, it is not for me, and it is never for me to tell them what they should or shouldn't spend on different things. But it does come back to that question: is your spending aligning with your values and your priorities? And if it is, if for you eating out with friends and getting takeaway and buying bought coffees and bought lunches is important, and for some people it is, if that is important for you, absolutely set yourself a budget that includes that and then stick to that. The problem with these guys is that they haven't really been thinking about it. They haven't really been thinking about the consequences of all this extra spending. It's not intentional, it's just that they've allowed themselves to slip into this automatic pilot with when they get takeaway and when they buy the coffees and their lunches and so on. And so what I wanted to show them, well, the first thing that I said to them is, have a sit down and work out what you really want your life to look like right now. What do you really want your life to look like? Does it include more takeaway? Does it include more bought coffees and lunches or just going out together? If it does, then make the budget realistic. Set a realistic mark that you know that you can respect and that you will stick to. There is no point having a budget that you're just blowing every single month because it's simply not realistic or giving you the sort of lifestyle that you want. And I said to him, find where that line is, create the budget that replicates that. And it's not just true every day. That could be true of their entertainment budget, their grooming budget, their date night budget. It could be true of any of these expenses. But what I'm asking them to do is figure out where is the line in the sand for them in terms of what they need to allocate to each of these expenses. Because what I showed him next was you could have your mortgage paid off inside 3 years and 10 months if we could identify, if we could create and stick to the budget and have this average monthly surplus here of $2,749. Now, their kids right now are age 5 and nearly 8. So by the time their kids are, 7, by the time their kids are sort of 10, 11 years old, they could have their mortgage paid off. And then think about what this $2,749 plus what they're already allocating to their home loan, where is it? Debts here, $1,500, what they're already allocating. If we add that together, there's about $4,200 a month that they would completely have spare. What that would do to your life at that point. And so I took them to the mortgage calculator on my Grandmaster's website. Now, as I said to you, they've done a great job. They got their home loan almost down to $100,000 before they started the family. They've done a few renovations to the house, which is why it's back up at $170,000. I think it's about 14 years into their mortgage or something like that. Interest rate's currently 6.29%. So if I actually take this out, so I'm just going to take out this extra payment here. If I said, okay, this is your current scenario. So if you keep paying your interest at the current rate and just spending all that surplus cash flow, you're going to have your mortgage paid off inside 14 years, and it's going to cost you about $86,000 in interest for the benefit of having that loan for that long. If, however, we said, no, we do want to pay off our home loan, that is a priority, and we want to make sure that our budget aligns with our priorities and the way we spend aligns with our priorities, then let's say we can put that $2,700 per month, $2,700, towards our mortgage from today. And just look at the change that makes down here. You can see down here, these guys will have that home loan paid off in 3 years and 10 months and save themselves $64,000 in interest. Now that's $64,000 after tax. $64,000 that so they basically have to earn about $85,000 to end up with that 65. Imagine trying to save that. I mean, that's money that you no longer need to pay to the bank and that you get to keep. Not to mention 3 years and 10 months versus 14 years. So again, it's never for me to tell my clients what their goals should be. And I always let my clients make their own decision. But I know that for these guys, paying off their home loan would be the ants pants. They would absolutely love to achieve that, especially by the time the kids start to reach high school, so they've got options for their education, but also they love traveling and they would love to take the kids overseas. So I know getting rid of this is deep down a priority for them, but sometimes we need to have this discussion to go, well, are you intentionally spending all this extra money? Is this actually what you want your life to look like? Or have you lost sight of the goal? In which case, let's get refocused. And for these guys, I'm meeting with them again in 2 weeks' time to sit down and actually create a debt repayment chart over the next 48 months. We'll put it on the chart. And they're going to make it a family affair. They're going to share it with the kids. They're going to have it stuck on the fridge. And every time they reach another 10 grand paid down, they're taking the kids out for ice cream. And this is such a valuable life lesson for them and for the kids. So what you need to start with is understanding, well, what are my priorities? what do I really want my budget to look like so that I can live a life that I'm enjoying and that I can respect. And then once I've got a budget I can respect and I know I can stick to, we can then identify, well, what does that leave you as a surplus, and start setting some fantastic goals with that surplus cash flow. Whether that's paying off your mortgage 10 years earlier, whether it's taking your kids overseas, putting them into a great private school, buying a new car, whatever it might be for you, it starts with knowing what you want to spend, what your values and your priorities are, and making sure that your budget aligns with that. Hope that's been helpful, guys. There's going to be more of these coming. I love sharing the stuff that I'm doing with my clients on a day-to-day basis. So hopefully you're finding this helpful. I look forward to seeing you in the next video.